Welcome to today's market report.
European shares climbed on Monday to end near record levels, led by technology stocks, which surged to their highest level this year as a surprise rise in German factory orders pointed to improving global demand and boosted sentiment. The pan-European Stoxx 600 index rose 0.7% to 475, just below its all-time high of 476 hit on 13th of August. Still, trading volumes were muted throughout the day due to a public holiday in the US. After Wall Street's tech-heavy Nasdaq index hit a record high on Friday, European tech stocks jumped 1.7%, with shares in chip equipment maker ASML and Dutch tech investor Prosus providing the biggest boost. The tech index ended at 829 points, its peak so far in 2021 and its highest since December 2000. Recent uncertainty over monetary policy and rising COVID-19 cases has pushed investors into technology stocks, which have been the best performing sector throughout the pandemic. Investors are also focusing on the European Central Bank meeting this week, as some of its hawkish policymakers are calling for it to start paring back bond purchases with inflation surging and the growth in Eurozone resilience. Last week, Bank of America Securities upgraded its euro area growth and inflation forecasts, predicting the bloc's economy would expand 4.8% this year, up from its previous forecast of 4.2%. Our base case scenario is that the ECB will announce a moderation of asset purchases in Q4 amid a solid economic growth backdrop, easier financing conditions, higher inflation forecasts, and lower net issuance of government bonds, according to UniCredit. Oil prices fell on Monday after Saudi Arabia's sharp cuts to crude contract prices for Asia revived concerns over the demand outlook. Brent crude futures fell to $72.22 per barrel. WTI futures was down 0.59% to $68.88 per barrel. Gold futures was down 0.45% to $1,825.50 per ounce. On the FX front, the GBP/USD dropped further during the American session and printed a fresh daily low at 138.17, slightly above Friday's low. It's hovering around 138.30, about to post the worst slide in 7 trading days. The pound is pulling back after being able to hold above 139. An upside correction of the US dollar and a modestly weaker pound pushed the GBP/USD to the downside. On Friday, the greenback dropped sharply after the non-farm payroll report, and on Monday it corrected higher. The dollar index is rising for the first time in 5 days, gaining 0.15%. Price action across financial markets remain quiet. US markets are closed for holidays, so trading volumes are likely to remain low until Tuesday. For the days ahead, the economic calendar looks light. The critical day in the UK and the US will be on Friday. In the US, the PPI will be released, with the headline expected to reach 8.2%. In the UK on Friday, July GDP, construction output, industrial production and construction data are due. Also, traders will continue to watch closely sentiments from Bank of England official ahead of 23rd of September meeting. In the US, Fed's comments would be interesting following the disappointing non-farm payroll. Eurodollar has been a slow burner in holiday-themed markets, but managed to sustain a comeback in the greenback as European traders bid up the single unit from a low of 118.55 to a high of 118.86. The price is oscillating near 118.70, while traders will get set for a busy week ahead, with the ECB the main highlight. Since the Jackson Hole, where Philip Lane first touted the idea of tapering, members of the ECB emerging from the flanks with a hawkish narrative. Lane has started a hard-fought and lengthy discussion amongst members on how to dismantle the crisis-fighting measures that have acted as the life support machine to the Eurozone throughout the crisis. This, in contrast to the dovish twists at the Federal Reserve, has seen Eurodollar rally by near to 2.1% since 20th of August, and from its lowest point of the US dollar bull cycle. On failures to break higher from here, the bears will be keen to test 117.80.
This is today's market news. Thanks for listening. We'll see you next time.